Hey y'all, I am Keith Collins, a mortgage lender passionate about helping people finance real estate smart, and today we're going to break down the updated California Dream for All Down Payment Assistance Program. This is a program that was released in California last year, and it literally ran out of money in 8 days, and they had a couple $100 million to give away. It was so good, the money went so fast. We actually saw some markets in California that actually saw an uptick in home prices due to the demand that was created based on this program. Pretty awesome program. It's back, it's been updated, it is different, and I want to go through it a little bit today. The two big things that are different on this program is the funds and how much you're actually getting. There's a cap limit on what it's up to, and they've added a clause that I'm going to dive into which says that you have to be a first-generation home buyer to be eligible for the program. That's going to be interesting. So borrower requirements are pretty easy. Each borrower must be a first-time home buyer. So this has to be the first home that you're buying to be eligible for this program. You have to be a U.S. citizen or a qualified alien, and then you're also going to have to qualify for the guidelines like income and debt ratio guidelines, which I'll go through for the main program. But the big part is at least one borrower has to be a first-generation home buyer. Oh, and a California resident. As with all down payment assistance programs through CalHFA, there is some home buyer education that has to be done. This was a little bit of a problem on the last CalHFA Dream for All program because people had to take the homeownership counseling course to be eligible for the program. There's only so many counseling and education companies that are offering this type of counseling or the approved counseling for the program that they get overwhelmed. Their days got pushed out by a couple of months in terms of when you were eligible to get a date for the counseling. They fixed this on this new release, but it's something we're gonna have to pay attention to. It is easy. It's usually an online course. It takes about 6 to 8 hours, or you can do an in-person version. There's a fee for it. I don't have the fee here. I'm just gonna define what a first-time home buyer is because I think sometimes people think a first-time home buyer is I've never owned a home, but the definition for CalHFA as a first-time home buyer is actually somebody who has not owned a home in the last 3 years. That's what we're calling a first-time home buyer. So everybody on the loan must be a first-time home buyer, and at least one person on the loan must be a first-generation home buyer. So one person could have owned a home before, the other person can't, nor can their family. It has to be a first-generation home buyer, which I'll get into. I'm actually gonna read this one because it's a little tricky, and this really relates to the first-generation home buyer. So the definition for CalHFA as a first-generation home buyer is as follows. A first-generation home buyer is defined as a home buyer who has not been on title or held ownership interest or have been named on a mortgage on a permanent foundation or owned land in the United States in the last 7 years. So that's the individual, a first-generation home buyer. To the best, and this is where it gets tricky, and, not or, and to the home buyer's present knowledge, whose parents, biological and adoptive, do not have any present ownership interest in a home in the United States, or if deceased, whose parents did not have any ownership interest at the time of their death in the United States. So what's going to be interesting with this is going to be an affidavit that you're actually going to have to sign, but we reach out to CalHFA. CalHFA has actually hired a third-party investigative service. So they're actually going to do some digging into your parental status and their ownership history on a home. So we got to be very clear that we have a first-generation home buyer on this because you won't be able to get the financing. And then there's a third caveat, an individual who has at any time been placed in foster care or institutional care. So if you have been in the foster care system or institutional care system, you would qualify for this program, and we don't have to dive into the first-generation aspect of it. Hey y'all, my goal with this channel is to teach you how to finance real estate smart. And if that is something that you're interested in, please make sure that you like this video and subscribe to my channel so that you get to see more content like this. So owner occupancy is pretty self-explanatory, but you have to own and occupy this property as your primary residence, and there are no non-occupant co-borrowers. So some programs allow a non-occupying borrower to co-sign to help you qualify. This program does not allow that. So the big question is, how much are you eligible for? And this is one of the changes from this revision to the previous, is it's up to $150,000. Whereas in the previous program, they actually didn't cap it. Technically, you get $200,000 or $300,000 if you're eligible for it. It is capped up to $150,000 up to 20%, right? So we can't go more than 20%. So those are the two caps, 20% down payment and closing costs, and then up to $150,000 for purchase. That's what we're eligible for with this program. Here's something that actually they added to this, which I think is really cool, is there was a concern in the previous program on the ability to refinance. So there is a repayment. It's a shared appreciation loan, meaning you will pay back what you borrowed. Let's say you borrowed up to $150,000. You'll pay back what you borrowed. You're also going to pay back a percentage of your appreciation on the property. It has to be paid back at the time that you sell or transfer or change the note. So our concern on the last program is, what about refinancing? are people going to be able to refinance if they get these funds? Because what could potentially happen is interest rates drop, you refinance, and if there's a caveat or term in there that you have to repay back what you borrowed, plus potentially any shared appreciation at the time of refinance, you may not have the equity in the property at that time to do that, and you wouldn't be eligible for a refinance. They actually added a caveat in here that says that you're allowed to, one time only, do a refinance of the first mortgage if interest rates drop, and you do not have to repay at that point in time the initial money that you borrowed or any of the shared appreciation. But if you were to sell at a later date after that refinance or do a transfer of any kind on title after that refinance, you're potentially going to have to pay back what you borrowed plus the shared appreciation at that time. So the income limits with this program, as with all CalHFA programs, do have income caps. If you make too much money, you're not going to be eligible. What's interesting with the income is depending on how much you make under the income cap, it changes the amount of appreciation you potentially have to pay back. That's the complicated part, which I'm going to get into detail in a moment. But what I want to talk about is the income limits. There's also links in the description where you can actually go to the entire county list for all of California that indicates what's the maximum income limit for the county. But just for example, like if we're looking at Placer County in Northern California, it's $180,000. If you're looking at Alameda County in Southern California, it's actually $234,000. So we do have some very generous income limits to be able to qualify for this program and also qualify for the home loan. So AMI, area median income limit. So there's income limits for the program, which I discussed previously, but then there's the area median income limit for the program. And the reason that's important is based on where you're at in the area median income determines how much of future appreciation you have to pay. If you are over 80% of the area median income, there are links in the description for this, but if you are over 80% of the area median income, you have to pay back 20% appreciation. So if you make $100,000 in appreciation, you have to pay back 20% of that. If you're under the 80% area median income limit for the area that you're buying in, it's 15%. So you'd only have to pay back 15% of future appreciation if you're under it. So that's where the area median income limits are really important to this program. And then what I'm actually going to do here is put up some images on the screen that kind of just go over how all these numbers work, and this is directly from CalHFA. And this is for somebody who's over the 80% number, so the shared appreciation is going to be 20%. So let's say they buy a $500,000 home, 20% is going to be $100,000, so they're going to get the entire $100,000 because you're capped at $150,000, but in this case you get the $100,000 because it's the lesser of 20% or $150,000. So the shared appreciation loan is $100,000. So what they're saying here, at time of sale, refinance or transfer, the new value is $700,000. At sale, there's going to be a actual purchase contract, or at time of transfer, there would be an appraisal. But that new value is $700,000. Here's what's really important. A lot of people have a misconception between equity and appreciation. Equity can be based on your principal reduction as well over time. So you're actually making more equity in the property. It is not based on that. It's purely based on, did the home go up in value? So in this case, home goes up to $700,000. There's $200,000 appreciation. You have to pay back 20% because we're over the area median income limit of 80%. That means you have to pay back $40,000 at the time of sale. Not a bad deal for getting a $100,000 loan that really has no payments associated with it. The next example here is if you're under the area median income limit of 80%. So if you buy a $400,000 home, you're going to get 20% of the sales price, which is going to be $80,000. That's the shared appreciation loan that you're getting. No payments due on that. That's actually going to reduce your overall mortgage payment, which is awesome. And then we're assuming here that you buy the home for $400,000. It goes up to $600,000. Again, it's based on appreciation, not equity. There's going to be a $200,000 appreciation. You're under the area median income limit, so you only have to participate in 15% of it. So your payback or shared appreciation payback in this scenario is going to be $30,000 because once again, you only have to pay back 15% appreciation because in this scenario, we're under 80% of the area median income limit. A couple basic things that we just need to go through. One, we are understanding that this is going to be released sometime in the spring, but we do not have a release date yet for CalHFA, so we need to get prepared. If you are thinking about this program, I would recommend that you get with the lender now to at least start the pre-approval process with the lender. We can't send anything to CalHFA until we have more details from CalHFA about how and when we're going to get the information to them. So I would get with your lender now to start the credit application, get the income documents, pull your credit, make sure that you're ready to go. Because remember, this program went in 8 days the last time it came out. I think this program is going to last a little bit longer because they've changed some of these parameters, but it's going to go fast. They're giving away 20% that you only have to pay back a portion of future appreciation. If you do have any other questions on down payment assistance, we have a lot of down payment assistance programs that you could go check out, including one which is really cool, which is our Movement Boost. None of them are going to compare to the CalHFA Dream for All, but if you don't qualify for that, we do have other options for you. Cool. That's California Dream for All. Done.
Okay.
Done.
All right.
That is really loud. I sure hope that wasn't distracting. Do you think that this is going to be a bother to people? It's a funny thing. You start shooting videos and then you realize that you're Velcro man in a video. I hope that wasn't distracting.